Picture a quiet suburban street outside Toronto in the early 2000s. Two-story homes, trimmed lawns, kids playing hockey in the driveway. A detached house sells for the price of a comfortable middle-class life, maybe 3 or 4 times the average household income. Fast forward 20 years. That same house? Now it costs 10 times the average income in some cities. And the neighbors? They're not teachers or mechanics anymore. They're leveraged investors, anxious first-time buyers, and households carrying debt loads that would have terrified their parents. And here's the twist. This isn't just a housing story. It's the story of an entire national economy that slowly, quietly, almost politely built itself on one single asset. An asset that now makes up more than a fifth of the country's GDP. An asset that drove household debt to some of the highest levels in the developed world. An asset whose prices rose more than 300% in major cities since the year 2000. This is the real story of Canada's economy. And it's not about maple syrup, oil, or tech startups. It's about houses. Because in modern Canada, the home isn't just where you live. It's the growth engine, the retirement plan, the credit machine, the wealth illusion, and the potential fault line. And once you see the numbers, you can't unsee them. Let's start with one simple, uncomfortable statistic. Real estate and housing-related activity now make up over 20% of Canada's GDP. That means roughly 1 out of every $5 generated in the entire economy comes from buying, selling, financing, building, or renting homes. Now compare that to other advanced economies. Most countries rely on manufacturing, technology, exports, or services. Canada? It relies on houses. And if you think that sounds like a stable foundation for a national economy, well, sweet summer child, let me show you the rest of the balance sheet. Because those rising home prices didn't come from nowhere. They were fueled by something much less romantic. Debt. As of the mid-2020s, Canadian households owed around $1.75 to $1.85 in debt for every single dollar of disposable income. That's roughly 175 to 185% debt to income, the highest level in the entire G7. And here's the kicker. About 3/4 of that debt comes from mortgages. In other words, Canadian households aren't drowning in credit cards or car loans. They're drowning in housing debt. So the entire system starts to look less like a diversified economy and more like a giant swimming pool filled with mortgage money. As long as home prices keep rising, everyone feels richer. Banks feel safe. Consumers spend more. Governments collect more taxes. Construction booms. But if prices stall, or worse, fall, that swimming pool turns into quicksand. And to understand how Canada got here, we have to go back to the beginning of the boom. Because at the start of the 2000s, Canada looked like the poster child of financial stability. While the US went through the subprime crisis in 2008, Canadian banks were praised as some of the safest in the world. Their mortgage standards were stricter. Their balance sheets were stronger. But something else was happening beneath the surface. Interest rates around the world were falling. Credit was cheap. And in Canada, that cheap credit flowed overwhelmingly into one place: housing. Instead of pouring capital into factories, technology, or productivity-enhancing investments, more and more money went into real estate. By the 2010s, investment in housing construction represented over 40% of total capital formation, higher than in most other G7 nations. Imagine an economy as a garden. Most countries plant a mix of crops: technology, manufacturing, services, exports. If one crop fails, the others keep the garden alive. Canada? It started planting almost everything in one field: housing. And at first, it looked like a miracle crop. Home prices climbed year after year, In major cities like Toronto and Vancouver, prices rose more than 300% since 2000. A modest house became $1 million asset. Homeowners felt wealthier, banks issued more loans, construction created jobs. Consumption rose. For a while, it looked like prosperity. But here's the problem with housing-driven growth. It doesn't actually produce much new productivity. A house sold for $400,000 or $1.4 million still provides the same number of bedrooms, the same kitchen, the same square footage. It doesn't make workers more efficient. It doesn't increase exports. It doesn't create new technology. It just becomes more expensive. And over time, Canada's productivity started to lag behind its peers. By the mid-2020s, Canadian labor productivity was roughly 30% lower than that of the United States. GDP per capita had fallen from about 90% of US levels in 2010 to roughly 75%. In other words, while houses were getting richer, the economy itself was getting relatively poor. It's like watching someone brag about the rising price of their antique furniture while their salary stays the same. Eventually, the math stops working. And the debt numbers show exactly how the math changed. By 2023, Canadian household debt had exceeded 100% of the country's entire GDP. That's one of the highest levels in the developed world. In comparison, U.S. household debt sat around 75% of GDP. Germany and France were even lower, below 60 to 65%. So Canadian households were more leveraged than almost any other major economy. And again, most of that leverage came from housing. By 2025, total household debts surpassed $3 trillion, with mortgage debt alone exceeding $2.2 trillion. Mortgages made up about 75% of all household borrowing. Think about what that means. If the housing market slows down, the biggest asset on household balance sheets stops rising. If interest rates rise, the biggest liability, mortgages, gets more expensive. So both sides of the balance sheet are tied to the same asset. That's not diversification. That's concentration risk. And the banking system reflects the same story. Canadian banks are heavily exposed to mortgage lending because that's where the demand is. Mortgages are considered relatively safe, especially with government-backed insurance programs. So, banks lend more. Prices rise. Households borrow more. Banks lend even more. It becomes a feedback loop, a self-reinforcing cycle where rising prices justify more debt, and more debt pushes prices even higher. Economists sometimes call this a housing-led growth model. But a more honest metaphor would be this. It's like building an entire national economy on top of a single, slowly inflating balloon. As long as the balloon keeps expanding, everything looks stable. But if it deflates, the whole structure comes down at once. And here's where the human cost starts to show. Because rising home prices don't just create wealth, they also create exclusion. By the early 2020s, roughly 1/3 of young Canadians were reconsidering buying a home altogether because of rising costs. Think about that. In a country where home ownership was once the middle-class dream, 1/3 of young people were already stepping away from it. Not because they didn't want a home, because they simply couldn't afford one. And this is where the system starts to look less like a prosperity engine and more like a generational transfer machine. Older homeowners see their wealth rise as prices increase. Younger households take on more debt just to enter the market. So the system keeps working, but only as long as new buyers keep stepping in with bigger mortgages. It's like a treadmill where every generation has to run faster than the one before. And here's the uncomfortable question. What happens when the next generation simply can't keep up? Because debt has limits, and Canada is already close to those limits. By the mid-2020s, debt service ratios, meaning the share of income going to interest and principal payments, had climbed above 15%. That means a significant chunk of household income was already locked into debt payments. And when more income goes to debt, less goes to everything else. Restaurants, travel, retail, entrepreneurship. In fact, by 2024, nearly half of Canadians reported difficulty meeting day-to-day expenses. So you get this strange contradiction. On paper, the country looks wealthy because housing assets are so valuable. But in everyday life, people feel poorer because so much of their income goes to housing costs. It's like living in a mansion while barely being able to afford groceries. And that brings us to the real structural risk. Because when an economy relies this heavily on one asset class, everything becomes sensitive to that asset's price. If housing prices keep rising, the economy keeps humming. But if they stall or fall, the effects spread everywhere. Household spending drops, construction slows, bank profits shrink, government tax revenues decline. And because so much debt is tied to housing, financial stability itself comes into question. The OECD has repeatedly warned that high household debt levels increase the risk of severe recessions. In other words, the very thing that powered Canada's growth could also become the trigger for its slowdown. Now, to be fair, this isn't a story of reckless subprime lending like the United States in 2008. Canadian mortgages are generally more conservative. Banks are better capitalized. Regulations are stricter. So this isn't a house of cards. It's more like a house of very expensive, very stable bricks, all stacked in one place. And that concentration is the real issue. Because the problem isn't just debt, it's what the debt is crowding out. When capital flows overwhelmingly into housing, it doesn't go into productivity-boosting investments. Fewer factories, fewer startups, less innovation. And over time, the economy becomes less dynamic. That's exactly what the productivity numbers suggest. Canada's output per worker has lagged behind the United States and other G7 nations for more than a decade. So the country faces a strange paradox. It's one of the richest nations in the world by household wealth, but that wealth is increasingly tied to one thing: real estate. Not factories, not technology, not global leading companies, just homes. And homes by themselves don't generate long-term economic growth. They generate comfort, stability, community, but they don't create export industries or productivity breakthroughs. So over time, the economy becomes less about building new things and more about trading the same houses back and forth at higher prices every year. It's like a village where everyone gets richer by selling the same gold coin to each other at a higher price every year. No new gold is mined. No new businesses are built, but the price of the coin keeps rising. Until one day, someone stops buying. And that's the central risk of Canada's housing-centric economy. Not an immediate crash, not a dramatic collapse, but a slow, grinding stagnation. An economy where debt keeps rising, productivity keeps lagging, young people struggle to buy homes, and growth becomes harder to sustain. So what's the final bill? Household debt, among the highest in the G7. Debt-to-income ratios near 180%. Over 20% of GDP tied to real estate. Productivity trailing major peers by wide margins. And an entire economic model leaning heavily on one asset class: housing. Now, none of this means Canada is doomed. The country still has natural resources, a strong financial system, and a highly educated population. But the structure of its economy has become increasingly dependent on rising home prices, and that's a fragile foundation for long-term prosperity. Because homes are supposed to be places to live, not the engine of an entire nation's growth. And the big question for Canada isn't whether housing will stay important. It's whether the country can build a second engine before the first one starts to sputter. Because when your entire economy rests on one asset class, you don't just have a housing market, you have a national bet.